Hello, everybody. You're very welcome to our virtual lunchtime briefing. I'm Kevin Manning, a principal in the Dublin office of Milliman. I have the easy job today of being Master of Ceremonies and introducing our three speakers. So we've got an interesting agenda lined up for you today. We're going to start with Sinead Clark, who'll be familiar to many of you. Sinead's principal in the Dublin office, and she's going to give a quick regulatory and market update with the recent publication of End 2019 SFCRs. There's some interesting pieces that Sinead is going to pull from those, and then to prove that the end of 2019 was a completely different world to the world we're in now, she's also going to talk a little bit about the market impact of COVID-19, and then also touch on the central bank's current consultation on recovery and resolution planning. And then our second speaker will also be familiar to you. That's Andrew Kay. Andrew's a principal in the Dublin office, and not for the first time, Andrew's going to be coming on to tell us that IFRS 17 is getting close. But this time, I'm assured he really means it. So it'll be interesting to get an update from Andrew on where things are at in terms of the IFRS 17 project. And then our third speaker may be less familiar to some of you in the Dublin market. We're delighted to be joined by Fred Vosvenieks, who's a principal in the London office. And he's going to be talking to us about the very timely topic of operational resilience. Fred was having kind of Wi-Fi warnings earlier, so he's hoping he doesn't have to deal with the irony of his Wi-Fi dropping during an operational resilience presentation. So we'll see how he gets on. He's also hoping to get some tips on the Tipperary County Hurling Championship apparently while he's here. So if anybody has any of those, please do pass them on to Fred. We're hoping to get you out. We promised to get you out by 1 o'clock so you can get to your lunches. But we will try to keep some time for questions and answers at the end. So please do use the Q&A chat facility to get some questions into us. And if we don't get to them through the live event, we'll come back to you afterwards by email. So that's the topic list for today. I won't waste any further time, and I will just hand over to our first speaker, Sinead.
Thanks, Kevin. Hello, everyone. So as Kevin said this morning, I am going to give a market update. I'm going to look at some analysis of the 2019 SFCRs initially, then look at a COVID-19 update with a focus on sales volumes, and then give a brief update on the CBI's most recent consultation paper, CP131, on preemptive recovery planning. So looking at the year-end 2019 SFCRs first, we've split our analysis between life and non-life markets, and we focused on some high-level takeaways, acknowledging basically, as Kevin said, that the world is a very different place now than it was at year-end 2019, and the COVID-19 is likely to have had a significant impact on the balance sheets of many insurers. So looking at life insurers initially, this sample focuses on the 10 largest companies in the Irish domiciles in Ireland based on own funds. So it includes some of the largest domestic insurers in the Irish market, in addition to some of the large cross-border insurers selling into Italy. And it also now includes some of the large UK companies, Standard Life International and Aviva Life and Pensions, that have increased significantly in size following portfolio transfers into the Irish entities during 2019 as a result of Brexit planning. So it represents about 80% of own funds in Ireland, so it's a significant portion of the Irish market. So for life insurers, what we've seen is that there has been a reduction in the average solvency ratio compared to 2018. The average solvency coverage ratio is now 169% compared to 187% in 2018. There's a couple of different reasons for this. Both some of the larger domestic insurers and cross-border insurers have had a reduction in their solvency coverage ratio, and also because of the mix has changed as a result of the transfers in, and those companies have a slightly lower solvency coverage ratio than we would have seen last year in the Irish market. But overall, it's still a very strong solvency coverage position for Irish insurers. Looking at the SCR breakdown then and the asset mix, really there hasn't been a huge amount of change here relative to last year. So the SCR breakdown, it's not surprising that life underwriting risk is still the largest component of the SCR, and market risk is the second largest component at 51% before diversification. And the breakdown of SCR, the percentage components are very similar to what we would have seen last year. Similarly, looking at the asset mix, bonds still make up the largest proportion of investments for life insurers at about 75%, and almost 50% of investments are held in government bonds, with 25% being held in corporate bonds. And that's very similar to what we've seen in the past. There hasn't been a huge amount of change there since Solvency II was introduced. Moving on to the non-life insurers then, we've a bigger sample of companies here. It's based on data from Solvency II Wire, and it reflects all of the non-life Irish domiciled companies that were included in the Solvency II Wire database at the start of July. So you can see from looking at the TPs there, it includes quite a broad range of different type of non-life liabilities. A significant portion, almost 50%, is general liability, and then the remainder is made up of a large portion of motor insurance, property insurance, and some other lines of business such as medical expense insurance, miscellaneous financial loss, and some smaller lines of business. So what we've seen for non-life insurers is that, again, there's been a reduction in the solvency coverage ratio from 222% at in 2018 down to 193% at in 2019. And this is a result of some of a reduction across some of the larger non-life insurers, but also it could also be driven by the fact that our sample is a little bit smaller this year relative to last year, just because we cut the data a little bit earlier. The SCR breakdown and the asset mix, similarly to life insurers, there hasn't been a huge amount of change here relative to previous years. What I do think is interesting, though, in comparison to the life insurers, I suppose, market risk makes up a much smaller proportion of the SCR for non-life insurers, which I suppose is as you'd expect, given that the liabilities tend to be shorter tail, so the assets to match them may be of a shorter duration, so there may be less volatile as a result of that. And also, you don't really have the second order effect that you would have for the unit linked companies and the life insurance market, whereby there'd be a hit to the future profits and the AMCs that those companies would be expecting or would be projecting in the market risk scenarios. The asset mix then, as I said, is broadly unchanged, but what is interesting here is that although the bond portfolio makes up a significant portion of the overall asset mix at about 70%, the split is the inverse of what we've seen in the life insurance market, with non-life insurers investing more heavily in government bonds at about 40%, and a lower portion in, non-life insurers investing more heavily in corporate bonds at about 40%, with a lower proportion than 30% invested in government bonds. So it's different to what we've seen for life insurers. So moving on then to the COVID-19 market update, the focus here is on life insurers and the domestic life insurance market in particular. We receive premium volumes on a monthly basis from the domestic life insurers for our temperature gauge, and I thought it would be useful to provide an insight into how sales have been impacted this year as a result of COVID-19 relative to 2019. So this graph shows the combined cumulative sales for the life and pensions market. It's split between annual premium, AP, and single premium, SP. So looking here, cumulative year-to-date figures for May are up on last year, with SP being up 4% and AP being up 17%. So on the whole, things are not looking too bad, but you can see that sales were up at the start of the year, and then there was a large jump in March, and then sales have, the cumulative figures have reduced steadily since then. So if we look at the figures on a monthly basis, we can see a clearer picture of what's happening there. So looking at Life, the two blue lines, Life AP and Life SP, you can see that the life insurance market got off to a good start in January and February, and the sales volumes were up on last year. But then in March, when we went into lockdown in Ireland, the Life SP was hit almost immediately, and the reduction has continued through April and May. For Life AP, there was a bit of a lag, and the sales volumes continued to remain above 2019 levels through March and April, but have since fallen in May. Looking at the pensions figures then, pensions AP and pensions SP represented by the green lines, again, they were both up in January and February relative to 2019. And there was a large increase in pension sales in March, which represents some group pensions business that was in the pipeline in advance of COVID. But then you can see since then, there's also been a hit to the pensions market, with pensions AP in particular falling off in in April, and then pensions AP falling off in May. So by the end of May, sales were down 20% in the pensions market, and between 30 to 50% in the life market relative to the sales in May 2019. So there has been a significant impact there on life and pension sales in the domestic market as a result of COVID. Looking at the protection and savings sales then, this represents a much smaller portion of the market, but I thought the figures were also interesting. The protection sales were relatively similar to 2019 in January and February, but then there was an immediate hit in March when we went into lockdown, and over April and May that has continued. However, looking at savings, there's a bit of a different picture, and in fact, sales in April for saving products were up significantly. And I think this is similar to some recent publications by the central bank in relation to deposit accounts with banks, whereby they've seen a increased savings for Irish consumers in April. I suppose as a result of the different spending behaviours for consumers when we were in lockdown in March and April. A lot of people put money into savings, and it's interesting to see that that's continued into the life insurance market as well. But there was a drop off in May then in savings products, perhaps as people began to fully understand the full scale of the crisis on the economy. So unfortunately, we don't have figures for June just yet, but anecdotally, what I'm hearing is that the June figures are still down on last year. However, there has been a little bit of an uptake since May, so it is likely that the insurance sales will be slightly better in June, but still down on 2019. What I thought was also interesting was to share some figures from Italy, primarily because Italy was a couple of weeks ahead of us in terms of lockdown and the virus really taking off there. And also, I suppose, because there's a large cross-border market from Ireland into Italy. So the focus here is on unit-linked business. And what you can see is that unit-linked sales in Italy got off to a phenomenal start at the start of the year. They were up 90% on the 2019 figures. And again, February was quite good. Italy went into lockdown towards the end of February, start of March. And you can see there was an immediate hit to the figures, to the sales volumes then, which continued through to April. But the Italian market is seeing a little bit of an uptake in May. So hopefully that is the kind of position we'll see in the Irish market when we analyse the June figures. Looking further into the future, then there have been a number of reports by Swiss Re that I've referred to here. There's also a report by Allianz. The Swiss Re report is predicting a 6% reduction in global life insurance sales volumes in 2020 and a 0.1% reduction in non-life sales volumes, based on a predicted 4% contraction in global GDP. So they're not predicting the decline to be as sharp as the global financial crisis, and they are predicting a V-shaped recovery where insurance premiums would return to pre-pandemic levels by 2021, which is kind of what we've seen in the graph there for Italy, that sort of V shape. Also, I thought it was interesting that in the UK, some financial advisors have noted that customers are more willing to talk about protection products now than they were pre-COVID. So there may be some behavioural change that could impact the insurance market also, which I suppose we've seen in other markets, such as the increase in online shopping and consumer behaviour changes elsewhere. However, there is still a lot of uncertainty. Some of the reports that have been produced to date don't really allow for the impact of a second wave. And I think since these reports have been prepared, the global the infection rates have been increasing globally, and so the probability of a second wave may be more likely. I know the OECD produced something recently that looked at 2 different waves, so that might be something for you to consider if you are looking at the possible future impact of the virus on the insurance market. And then finally, remaining kind of on COVID-19, I wanted to give an EIOPA update. So as many of the Solvency II 2020 review has been delayed, EIOPA is expected to publish final advice now at the end of December. It was expected to be published in June before the pandemic. The main reason for the delay is so that EIOPA can hold a second holistic assessment based on a 30th of June reference date to assess the impact of the proposed changes from the 2020 review on insurers' balance sheets, allowing for the impact of COVID-19. So we understand that there were 24 insurance companies included in the initial assessment in Ireland, and of those, a subset of 14 have been selected for the second assessment that's currently taking place. And then EIOPA has also recently, last week, released a paper on its expectations in relation to product oversight and governance. And it has been called on insurers to identify any products affected by COVID-19, assess possible unfair treatment to customers, and consider proportionate remedial measures. So this is in line, I suppose, with publications from EIOPA at the start of the pandemic, and what we would have seen from the CBI throughout the pandemic as well. So there is still quite a focus on insurers treating customers fairly, in particular where there may have been some ambiguity in terms of terms and conditions. So finally, I just want to talk about the latest consultation paper from the Central Bank of Ireland, CP 131, on preemptive recovery planning for insurers and reinsurers. The consultation paper was published on the 25th of June, and the closing date for responses is the 30th of October 2020, and includes draft regulations and guidelines for companies to establish and maintain a recovery plan. And it seems to apply to all firms in Ireland that are within the scope of Solvency II, although it's not particularly clear from the current consultation, although I assume that will be clarified at a later stage. For Prism High and Medium High firms, the current proposals require companies to submit their recovery plans to the Central Bank of Ireland. The first ones are due in 2021, although the exact date hasn't been advised just yet, and they'll need to be resubmitted each year following board approval. For other companies, so lower rated Prism companies, the recovery plan needs to be made available to the CBI upon request. So the main aim of the consultation paper, is to inform the strategic decision-making process during crisis, because it can become quite difficult for companies to develop a strategy in the middle of a crisis, and it can result in some limitations. So the consultation paper includes regulations and guidelines And I've included a brief summary of both on this slide. So you can see that the regulations set out the main requirements in terms of review and the approval process, and they also include some detail on the what should be included within the content of the recovery plan. And in fact, the consultation paper goes so far as to almost provide a draft terms and conditions or template for companies to prepare their recovery plan, and then it provides details on what's required under each section. So it can be quite useful for insurers that don't currently have a recovery plan in place and are starting to develop one from scratch. The guidelines then provide further detail on what the plan should cover, and they include some guidelines in relation to proportionality. There's requirements to include a very detailed indicator framework, and also some impact and feasibility assessments for recovery options. So the proposal is quite detailed, and unfortunately I don't have time to go through all of the requirements today. But what I would say is that for companies that already have recovery plans in place, the proposals set out in the consultation paper do go a bit further than what we're currently seeing in the market, and some insurers are likely to have to revisit their current plans and update them in order to comply with these requirements if they come into effect as based on the consultation plan. In particular, some of the indicators required within the indicator framework are very detailed, and also the impact and feasibility assessments that are required are also very detailed. So with that in mind, we've actually earlier today published a briefing note on the proposed guidelines, and that is available, on this link here. So if you are interested in recovery and resolution planning and the consultation, I would advise you to have a look at that briefing note, as it's quite a good summary of the guidelines. And with that, I'm going to thank you for listening and hand you over to Andrew, who is going to talk about IFRS 17.
Thanks, Sinead. Good afternoon, everyone. So yeah, I'll now give a brief update on latest developments with IFRS 17. Quickly, by way of background, IFRS 17, as we know, is the new accounting standard for insurance contracts and reinsurance contracts. It replaces IFRS 4. And the standard was originally issued back in May 2017 by the IASB, the Accounting Standards Board. However, there were a number of concerns raised by industry with the new standard, which led to a period of further consultation with industry and the IASB. And that's culminated in the publication just last month of the amended standard IFRS 17 that aims to address the various industry feedback that was raised. So today I just wanted to give a brief overview of the main amendments to the standard and the impact that they'll have for companies, and then also look at some of the hot topics we're seeing with companies as part of their implementation projects. So firstly, the IASB has classified the amendments into three different categories. Firstly, those that they put in place to ease the transition to the new standard. Secondly, those that are aimed at improving the explanation of the results of the new IFRS 17 calculations. And then amendments that are related to reducing the costs of implementation. Now, firstly, I guess one of the main changes is that the effective date for IFRS 17 has been extended out to 2023. So it was 2021, but based on the industry feedback, the IASB has moved that out by 2 years, and that's really a really welcome change for the insurance industry to give them the additional time that's needed to get ready for the new standard. Also, in relation to IFRS 9, which is the standard that's used for valuing your assets, companies have been given the option to defer implementation of that till the same date as IFRS 17. and that's really to ensure that there's consistency between the asset and liability valuation to reduce any mismatches that would otherwise arise. So if we look at the new timeline now, we can see there that we've got the transition date, which is the start of the comparative period. So when you have to prepare your opening balance sheet, that's at the start of 22. And then we have reporting under IFRS 17 commencing from 1st of January 2023. And really a next step for companies is to assess the impact of these amendments on your IFRS 17 project to take them into account. The calculation of that opening balance sheet as at the transition date, it's a huge undertaking for companies. And the amendments here do provide some relief for certain cases. So firstly, if you had contracts you'd acquired in a portfolio transfer or business combination before the transition date, you've got an option there to treat the claim settlement as a liability for incurred claims rather than a liability for remaining coverage. So that's a slightly simpler calculation. Secondly, then, for companies that are using what's called the risk mitigation option, you've got the option now of applying that option from the start of the transition period rather than from the effective date of IFRS 17. And then thirdly, for investment contracts with discretionary participation features, and this covers your with profits style business, you can now assess the eligibility for the variable fee approach for that business as at the transition date rather than having to go back to contract inception. So I think certainly these amendments are helpful for companies. I don't think they go far enough, though, not as far as industry would have liked, particularly, say, with that risk mitigation option. Companies would have liked the ability to apply that back from contract inception. But some relief here for companies. And one of the other criticisms of IFRS 17 in the original standard was that it didn't reflect the true economic position for insurers, and that led to then results that were hard to explain to your stakeholders. So these next set of amendments aimed at improving the explanation of results and better reflecting the true economic position. So firstly, in relation to acquisition costs, these all previously had to be allocated to the first year of when contracts were sold, which then led to the case for some renewable products that they'd all be picking up the acquisition expenses in year one for the first year of sales, and therefore being shown as loss-making or onerous contracts, whereas that wasn't really the case in practice when you took into account the future renewals. So the amendment here is an important one, and it allows companies to defer some of these acquisition expenses and allocate them towards future renewals, which then gives a position where the results are more aligned to what the expected economic position. And secondly, in relation to reinsurance contracts that an insurer holds, if these are profitable, companies can now recognise the upfront profits on those and offset them against any loss-making direct insurance contracts that they're matched against. Whereas previously this wasn't an option under the original standard. So this change again reduces that mismatch between the direct insurance contracts and the reinsurance contracts held, and now gives results that more reflect the true aggregate economic position for the company. There's also an amendment to allow profits to be recognised over time in line with the provision of either insurance coverage or the provision of investment-related services under the general model, whereas previously it had to be based on insurance coverage. And this amendment here now allows a more sensible pattern of profits over time for certain contracts that provide both insurance and investment services. So if you take the likes of deferred annuities or even certain unit-linked protection contracts, this will give a more sensible profit pattern. And then secondly here, For companies that were using or are using reinsurance to mitigate financial risk, they now have the option of using this what's called the risk mitigation option under Solvency II, under IFRS 17, to better reflect the actual economics position of the reinsurance asset when matched against the insurance contract liability. So again, this amendment here is reducing that mismatch that otherwise would have been there under the previous version of the standard. And then finally, there are a number of amendments aimed at reducing the costs of implementation. So firstly, in relation to which contracts are in scope, there was some amendments there that excluded certain credit card contracts and certain loans that had insurance benefits associated with them. It could be excluded from scope and therefore reduce the costs of implementation for those entities. Secondly, the presentation in the balance sheet is simplified, where you can now present insurance contracts, assets and liabilities as at the portfolio level, rather than having to go down to more granular group of contracts level. So that'll reduce the cost of implementation there. And then in relation to interim reporting, companies have now been given the option of changing the previous estimates in your interim financial statements, which again will reduce the costs of having to go back and restate previous figures. So I think overall, the amendments address a number of areas of concern that have been raised by the industry. However, not everything was addressed. And in particular, the requirement to carry out the calculations at annual cohort level is still remain, and this particular requirement has caused a lot of the data and systems challenges for companies as part of their implementation projects, because you're having to calculate the CSM at that much more granular annual cohort level, and then track and monitor that over time. However, this was an area where the IASB felt that the annual cohort requirement provided important information about insurers' profitability over time, so that's why they've kept this requirement in place. Now, there were a number of other areas where amendments weren't made, but I think this annual cohort requirement is I think one of the main ones for the insurance industry. And then on my final slide for today, I just wanted to summarise some of the current hot topics that we're working on with clients as part of their IFRS 17 implementation projects. So starting at the left there in relation to the technical methodology, areas such as how to set the discount rates, and if you have illiquid liabilities, how to set the liquidity premium, which contracts to apply those to is still an area that some companies are looking at. Some companies are looking to use a Solvency II style approach, but others are then looking to use a more economic approach, say without the UFR for longer duration contracts. The whole area of the risk adjustment, again on that, companies are looking at firstly the approach and whether they're using a Solvency II style cost of capital style approach for determining their risk adjustment, which risks are they including or excluding from that. But then whichever methodology, companies are then still deciding where to calibrate that level of allowance for risk in the liabilities, and how to convert that from say a 1-year view to a confidence level over the lifetime of the business. Contract classification, again, is still proving challenging for some types of products to see if they're eligible for the variable fee approach. And companies carrying out assessments there to see if they meet the requirements. And then if companies have business with investment guarantees and are using stochastic modelling to value the liabilities, there's certain challenges there to apply that to under an IFRS 17 framework. Then secondly, in the blue bubble, we had the whole area of the financial impact analysis and companies looking at what the impact of IFRS 17 is going to be on their opening balance sheet and then their profit and loss going forward. And an important decision there for the company's IFRS 17 financial strategy is really how much of the future profits you can release to the balance sheet into equity versus retaining within the CSM and having as future profits in the future in future years and perhaps less volatile profits. And that's an important decision, can impact dividend capacity and also group capital ratios for certain entities. And then once those results are prepared, companies are spending a lot of time on training and discussing the results with the board and other stakeholders because the results do look quite different. So a fair bit of time needed on that. In the green bubble, we have the whole area of actuarial modelling and a lot of time being spent on adapting actuarial models to calculate the CSM and do the calculations for your gross business and also for reinsurance contracts held. There's also a lot of valuation runs needed to determine the analysis of movement over time so that you can populate your financial statements with the various changes. And we're helping companies there with automation of that process to ensure a fast and efficient valuation process. And then once those models are built, companies are then looking at independent validation of the results because the results that are coming out are quite different to what you currently have. And so you need to get very comfortable with those, that they're accurate. And then the last red bubble there, we have the whole area of that opening balance sheet and that first transition to IFRS 17. And areas we're assisting companies with is helping to justify whether the full retrospective approach is impracticable or not. And then if not, and the company elects to use a fair value approach, how to define that fair value methodology and looking then at what impact that has on the contractual service margin. And then across all of these areas and across the whole project, you have the various challenges of getting the data that's needed and getting the systems in place and having a streamlined reporting process as possible to hit the very short IFRS reporting deadlines. So I'd say to wrap up, I think the amendments to the standard, there's a number of things in there that are very welcome and will certainly help with implementation. But there's still a lot of work remaining for companies over the next couple of years. So with that, thank you, and I'll now hand over to Fred, who's going to talk to us about operational resilience.
Good afternoon, everyone. Now, Kevin mentioned at the start there was potentially a touch of irony to the fact that my Wi-Fi connection was potentially failing me. We'll touch wood, that's still okay for now, but got me thinking that potentially there was some irony to my Irish colleagues choosing someone from the UK to speak about good practices in the context of COVID-19, but nevertheless, here I am and delighted to be speaking to you this afternoon. I suppose make an obvious point is operational resilience has been received an awful lot of attention internally amongst firms and when firms have been interacting with or engaging with their regulators. Certainly I've had a good amount of my work and the conversations that I've had with firms over the past 3 to 4 months has been either directly or indirectly related to operational resilience. So hoping to share some of the insight that we've gained from those conversations. I think intuitively most people hopefully have a good understanding about what we mean by operational resilience. It's a bit more of an established industry term than perhaps it was 2 or 3 years ago, but certainly when we're talking to clients about it, we tend to articulate it as a firm's ability to anticipate potential operational disruptions, and also, if necessary, if things do go wrong or things do happen, it's their ability to respond and manage through that operational disruption, and critically in a way that protects value. And I think that's one of the elements which is potentially absent in relation to operational resilience at the moment, that it is about protecting your business, but also protecting the value and maintaining opportunities available to the business. Let's go back a slide. There we go. And just to provide some context, I guess it's useful to think about how operational resilience frameworks sit in the context of some of your other mechanisms in place. And if I think about operational resilience in contrast with disaster recovery and business continuity planning, I think the key difference there is that those processes, disaster recovery and business continuity planning, are designed and implemented on the basis that you'll go back, that the firm and the external environment will revert to the position that they were in prior to having to trigger those disaster recovery or business continuity processes. And the key difference with operational resilience is successful operational resilience is about recognizing that the world might not return to the same position that it was in. So it's about thinking through how the business needs to adapt to go forward as you emerge out of the crisis, and certainly in the context of the current COVID-19 crisis that we find ourselves in. It's not, operational resilience is not just about having the operational performance and integrity to kind of survive the crisis, but it's actually positioning the business operationally so you can grow out of the crisis. Now, there's somewhat of a kind of a well-established paper trail in terms of how the maturity of operational resilience thinking has matured in the insurance and the financial services industry. Operational resilience was certainly a hot topic before the onset of the crisis, notably the Bank of England, the PRA and the FCA in the UK jointly authored and published a number of consultation papers on the topic at the end of last year, before the onset of the crisis. Not going to go through what those say, but I think given that they are consultations, I think it will be interesting to see how the regulators in the UK and regulators in other areas developing similar regimes around operational resilience, how those proposals and consultations change in response to the regulators' experience of regulating firms through the crisis, which is absolutely required flexibility and agility on the regulators' part. And of course, it will also be really important for firms themselves to have a look at those proposals about regulatory requirements are expected to look like, what regulatory expectations will be, and look at those proposals in the context of their experience of how they've managed the business operationally over the crisis. And I think there's a lot of good thinking that's already been developed in relation to operational resilience, and I think those papers published in the UK are a really good place to start. In terms of the fundamentals of successful operational resilience, or dimensions, as I've referred to them as on the slide, I think firstly there's a really big cultural element to being operationally resilient in terms of the way that the business thinks about and discusses operational uncertainty in the business strategically and in the context of its risk profile. I think resilience really needs to be, and not a lot of firms are there at the moment, but resilience really needs to be baked in when a firm is considering making changes to its operating model, the way it operates, or is having to respond to changes in the external environment. As part of that business case, as part of that risk assessment, firms need to be thinking about how those changes will impact the susceptibility of the business to operational disruption. Secondly, key part is, I suppose, quite obviously, is being aware and managing your key vulnerabilities. So which are the parts of the business which are at most at risk or are most susceptible to operational disruption, and really focusing your thinking around those vulnerabilities. Thirdly, and this I suppose is probably the area which I see is most absent from thinking around operational resilience and scenario analysis, is grounding your thinking or rebasing your thinking around where you are today, and based on where you are today, your vision of the future. I think so much, particularly in the realm of scenario analysis, from an operational perspective, is based on this kind of ideal or default view around how the business is performing from an operational perspective and the challenges that it's facing, rather than actually reflecting what's going on at the moment. And finally, the business needs an adaptive capacity. So when you do expect that the business or the external environment isn't going to revert to the state it was in before, you need to be proactive in identifying the changes you're going to need to make to your operating model in order to continue to be successful, and thinking about what's needed to execute on those changes. Now, as I noted previously, an awful lot of time has been spent both at the onset of the lockdown and remote working and social distancing, and over the last 3 to 4 months, by firms on restoring their operational And as firms continue to think about their operational resilience, I think it is helpful to think about these kind of 3 overlapping but distinct timeframes. First being the lockdown, kind of where we are at the moment. The second being the transition period, when firms start to move out of the current temporary operating model and going back to something approaching normality, and then in the medium to longer term, thinking about what the new normal looks like. And I'm conscious that phrase "new normal" is already growing. Some people are growing tired of that new phrase that's been coined. In terms of the lockdown period, I think where firms are at the moment in terms of their operational resilience is they're now in a position where they can look back at the changes they've made over the past 3 to 4 months and think about what lessons they've learned. Did they react quick enough? Did the changes they made to enable their staff to carry on working, for the business to be able to carry on engaging and kind of servicing customers? Were they the right ones? Were they made quick enough? And also, firms very much still need to be actively managing the operational challenges of being in this, slightly unusual state for a prolonged period. And the one thing I really want to call out in the context of kind of, what I've thought about in the lockdown is that of the firms I've spoken to and what's in public disclosures and some of the interviews that senior people with insurers have given is there's an admission that there were some challenges in the first couple of weeks to get businesses running in a remote environment, but largely that went better than firms were expecting. And after about 3-4 weeks, firms had restored their operational performance, did consider their operational integrity to be restored. And what's missing for me from that narrative, I guess, and this is difficult when you're just speaking to someone external or you're publishing a public document, is acknowledging that certain parts of the business are now much more susceptible to further operational disruption than they were. So there's this raised sensitivity across the business to further operational disruption. And alongside that, some of the recovery actions and risk mitigation that would have been, that was in place and was deemed to be effective pre-crisis is probably, in some instances is no longer available, and in others is not as effective as you might think it would be, given how this crisis has impacted your own business, suppliers, and the way your customers are behaving and interacting with the business. Other thing I'd note at the other end of, I suppose, the spectrum in the context of medium to longer term thinking is there's already an awful lot of discussion at senior levels within firms about how the location strategy should change, how working environment should change, to kind of bank some of the positives that come out of this crisis in terms of cost reduction or more efficient ways of working, and bank those for the longer term. And that really needs to be balanced against a need to retain an operationally resilient organisation, and the ability to be flexible, so to not close off certain avenues that you had open because they didn't work for you or weren't needed during the crisis. If we turn now, and I'll spend a couple of minutes on each of these, just to some specific learning points in relation to some different areas that are relevant to operational resilience. I think in the context of firms' business models, as firms have transitioned to different ways of interacting with their customers, different ways of interacting internally, and definitely characterized by a lot more remote working, there's been a mix of responses to that operating model. Some businesses as a whole have found it really positive and actually enabled them to do business easier. Others have found it more challenging, and if I look at individual departments, some of those have adjusted to the new operating model better than others. And just as I suppose an awful lot has been written about kind of the crisis invalidating this long-held assumption that everyone needs to be in the office, I think care needs to be taken when firms think about their operating model on a longer term basis going forward, not to apply necessarily a blanket strategy, that some nuance across different departments and functions will be necessary. In terms of operational change, again, an awful lot across industries, which has been talked about in the context of how quite significant changes to business processes, certainly to IT infrastructure, have been implemented over the crisis. To a large extent, a lot of that was kind of already in firms' plans, and those things have been kind of accelerated and brought forward. But I think the key thing to note there is just the pace that firms have been able to make or have decided to implement those changes in order to be able to carry on operating and servicing their customers. I think firms have been quite surprised by how agile they actually have found themselves to be. I think insurance firms, certainly on the life side, are often kind of compared to a kind of a cruise liner. It takes ages to turn once you've decided to change. But there's some real agility shown by the industry, and firms need to think, I guess, about, do they want to retain that agility in making decisions and executing on those decisions? The views on that are likely to differ by stakeholder, and firms need to be thinking about the implications of maybe being a bit more agile when it comes to the decision making. As we go into that middle block, as we start to transition out of the lockdown and kind of return to normal business practices, there'll be a set of those operational changes that were made to enable firms to carry on operating, that firms will want to retain because they've been really effective in terms of supporting staff or enabling better interaction with customers. And firms will need just because they've been successful so far over the lockdown, firms will need to think about how they can continue to be implemented. And the other side is obviously some changes will have been made that would normally be outside of risk appetite or outside of risk preferences that firms don't necessarily want to carry through into the longer term, and those will need to be safely unwound. Don't have an awful amount of time left, so just touch briefly on the other three. Governance, I think what I've observed, of what we've at Milliman have collectively observed, is firms have had to, in the context of this speed of decision making and speed and pace of operational change, have had to implement quite abridged governance structures. Decisions have been made by BCP teams, by COVID-19 working groups, and those haven't always had the same membership or the same time horizon or the same priorities, understandably, as you would have done in kind of quote unquote normal circumstances. And I think while all of that is quite reasonable in the context of what we faced as an industry, if that leads to longer term or issues which are uncovered in the future, you know, that's still going to be an issue. So I would certainly encourage firms to, at some point, cast a kind of critical retrospective lens on the governance processes that have been followed. From a human capital perspective, I think, you know, heard lots from firms about how productivity is increased, and that's great. You know, in some places that's, you know, that's been critical to manage increased workloads, increased customer queries, and some of it has been driven by the new tools which have been rapidly rolled out, and some people have remarked to me that there's more interaction and collaboration than there ever was when people were sat together in their desks in the office. So again, there's a question of, okay, how do we retain that? But there's also a question in the short and immediate term of how sustainable is that? You know, can the people within your organisation really continue to work remotely and maintain that level of productivity? And I think, you know, if someone were to say, what's the key dependency or the critical driver to operational resilience, I think near the top of the list, or the top of the list for me, would be the resilience of your staff and your colleagues. So monitoring the well-being of your staff needs to be absolutely critical within your operational resilience frameworks, particularly in stress circumstances. Management need to get ahead of the concerns and pressures which are building up for staff, and give reassurance that the operating model will change to accommodate those concerns, and really know when to permanently change the management narrative from one around disaster recovery and business continuity to this is how we're going to operate the business for the long term. BCP, I'm gonna skip over. I'll say nothing more than I think the crisis did show up that some elements of BCP planning weren't fit for purpose. That's evidenced by certain elements of the BCP plan being not relevant or redundant, and some of the very kind of just-in-time short-term activity that firms really hadn't planned for but had to take at the beginning of the lockdown crisis. Kevin, I hope you provide me 30 seconds just on risk management, the implications for risk management. Top of the list is, I think the crisis is, in the context of operational resilience, the crisis has really highlighted that when the business steps up a gear, starts making changes at pace, starts moving in, and operating in different ways, risk management needs to keep pace with the speed of the business and adapt its own processes and have the capability to reappraise risk appetite and risk limits in the context of the change of circumstances. Final bullet point would be around metrics and limits, particularly business impact tolerances. The crisis has provided some really valuable data points around just how much disruption businesses can withstand. And it's also pointed to the need for risk metrics and limits to be dynamic rather than static. And when circumstances do change, those need to be recalibrated. So with that, I'll leave the final slide for you to have a look at. I know you've got access to the slides, and I'm going to hand you back to Kevin.
Okay, thanks very much, Fred, for a very interesting presentation. I've managed to do something to my headphones here in the meantime, so hopefully people can still hear me okay. And thank you to all of our speakers. So we did promise to get you out by 1 o'clock, so there is still time for a couple of questions. We've had a couple of questions come in, but they're sort of more general questions. I guess, Fred, maybe just one point that you touched on there, which I thought was interesting. Apart from the cruise liner analogy, I'm not sure anybody wants to be compared to a cruise ship at the moment in this new world. But I guess I thought it was an interesting point. I was kind of impressed when I look at our clients and I look at our own reaction to the pandemic, how quickly people have adapted to the situation and to the change of working from home, and how the Wi-Fi networks, notwithstanding the occasional issue, have actually sort of held up reasonably well across the country and so on. So there's a bit of patting ourselves on the back, but I think your point about heightened operational risk in that new environment is an interesting one. And I'm wondering, I guess, when companies are firefighting and sort of dealing with a crisis, are you seeing much time for companies to take a step back and sort of look at how can we learn from this situation in terms of our operational resilience looking forward?
No, Kevin, I think it's I suppose some of what I said was quite idealistic in a sense. I think it is really challenging to operate, you know, in an agile management mode and to be able to step back when you're still actively thinking about the challenges that the business is facing and say, okay, well, what have we learned? What did we do wrong in the past 3 to 4 months? So there's some of that going on within certain teams, but whether it's flowing through at the strategic and the management level, that's just challenging, I think, at the moment.
Yeah, okay. Thanks for that. Well, we are past 1 o'clock at this point. There was a question coming in around whether a recording would be available. So yes, we will. We are recording the session and we'll make that available to people. I do want to give one final plug before we finish to the Milliman Olympics. You will hopefully have gotten an email about this. I don't know why we're doing this, so if that's your question. And also, I don't really know anything about Korean baseball or Tipperary hurling, but if you are interested in taking part, get your entry in before the end of next week, and it will hopefully be some fun over the next couple of months. Thank you very much, everybody, for joining today, and we will send out links to the recording in due course. Thanks very much.